Welcome to The Explainer. Today, we're diving into a real head-scratcher. How does a company nearly double its revenue but still end up with a massive loss? We're going to break down the numbers behind the paradox at Browns Investments.
Okay, before we really get into the weeds, just the usual heads up. This is purely for educational purposes. This is definitely not financial advice.
All right, look at this. On the surface, you'd think this is an incredible growth story. Browns Investments PLC reported an absolutely staggering 89% jump in their revenue, hitting 49.5 billion rupees.
But, and this is a huge but, all that massive growth came with a net loss of nearly 15 billion rupees. So the real question is, where on earth did all that money go?
So as we start to peel back the layers on their September 2025 financials, what we find is a company that's in a very specific and honestly a very dangerous position. Let's get into it.
Okay, so let's start with their profit engine. Or maybe it's more accurate to call it their broken profit engine.
So you see revenue just exploding, right? Up 89%. Looks great. But the cost to make those sales? Well, that went up even faster, jumping by 108%. It's completely swallowing up all that new growth.
And here's what that does to your business. Their gross profit margin, that's the money they make on each sale, absolutely collapsed. It fell from a healthy 23% all the way down to just 16%.
But you know, as bad as that is, it's not even the main problem here. The real killer, the thing that's really dragging this company down, is the debt.
Just look at this. It's completely out of whack. The whole company managed to generate an operating profit of 3.2 billion rupees, okay? But their finance cost, just the interest they pay on their loans, was 18 billion. So what does that really mean? It means their actual operations only make enough money to cover 18% of their interest bill. The business is being wiped out almost 6 times over just by the cost of servicing its own debt. So you gotta be asking, right? Is any part of this company actually profitable? Well, if you look at where the sales are coming from, one single division is the giant here. Manufacturing and trading. It brings in 64% of all revenue. But here's the kicker. That division bringing in most of the revenue, it's actually losing 2.2 billion rupees. It turns out construction is the only thing propping this whole company up. Meanwhile, leisure, trading, and especially investments are just bleeding cash. All right, let's pivot over to the balance sheet. This is where we see this picture of a huge, asset-heavy company, but one that is maybe not the fortress it appears to be. I mean, the number's enormous. The company is sitting on over 680 billion rupees in assets. On paper, they look like a fortress, right? But most of that is locked up in property and equipment.
And here's the thing, you can't exactly pay your bills with a factory wing. And that's the problem. They have a serious cash crunch. The bills they have to pay right now are almost 15 billion more than the cash they have ready to spend. That is a massive red flag.
And if you dig deep into those liabilities, you find something that is a huge structural risk. A whopping 97 billion rupees is money they owe to related parties. Basically, they're heavily dependent on internal funding just to keep the lights on.
Okay, now we get to the moment of truth for any company. You see, you can play games with profits, but you can't hide what's really happening with the cash. The cash flow statement tells the real story.
You know, there's that old saying in finance that is perfect for this situation. Profit is an opinion, but cash is a fact. And that has never been more true than right here.
And here it is, the bombshell. The business didn't make cash from its operations, it burned through it. A massive 24.8 billion rupees gone in just 6 months. This is a 5-alarm fire. So why? Why did they burn through all that cash? Well, it wasn't a normal business loss. It was a strategic choice. They decided to prioritize paying down 15.5 billion rupees to those related companies. And in doing so, they basically sucked all the cash right out of their operations. So how are they even still operating? Well, they're selling things off. They liquidated almost 29 billion in financial assets. And on top of that, they took on another 12 billion in new loans. This isn't a long-term strategy. This is just surviving day to day. So let's put all the pieces of this investigation together and get to the final verdict on the company's financial health. The key numbers paint a really clear and, frankly, disturbing picture. We're seeing a critical inability to pay its interest, poor returns that are destroying shareholder value,
immediate cash strain, and a really inefficient use of its massive asset base.
This is the classic textbook definition of an asset-rich, cash-poor company. They own a ton of valuable stuff, but they just don't have the liquid cash needed to pay their bills, which is putting them under some serious financial stress.
And all of this leaves us with one final big, flashing question. When your core business is burning through cash and you're selling off pieces of the company just to pay the interest on your debt, you have to ask yourself, how long can that possibly last?